Hey, thanks for joining me for our December 2021 SWAN report. This is Andrew McNair from SWAN Capital, and I want to wish all of you a Merry Christmas as we wrap up the year of 2021. In this month's video, we're going to discuss the recent headlines that influence the financial markets, but I also want to provide you some perspective on what these actual developments mean for you as an investor over the next few months ahead. Now, as always, please stay tuned at the end of this video for some required disclosure statements. So at SWAN Capital, our market outlook remains cautious, and here's why. The first is new COVID variants. The second is inflation, and the third is pricing of the market. Right now, the PE ratio is at nearly all-time highs. So as we emerge from the Thanksgiving holiday weekend, the large stock market drop on Black Friday was fresh in investors' minds. And Black Friday weekend shopping actually is all those readings that come in from the retailers offered really little optimism as they were still well below pre-pandemic levels. Consumers seem to have front-loaded their purchases in response to supply chain concerns. They're worried that they won't get their items, or they're worried they're going to pay more if they order later. So markets rallied for a few days only to fizzle after each session. The market also decreased following the discovery of the Omicron variant. We still need to learn a lot about the new coronavirus variant, but the restrictions many feared haven't appeared so far. So that's the great news. President Joe Biden banned travel from South Africa, which is to be expected because that's where the variant was originally identified. But there has been no talk of new lockdowns, school closures, or additional mandates in the US. Instead, we've been encouraged to go get vaccinated, boosted, or wear masks. What was the news was going around that people will need to be tested before entering the US or to quarantine for 7 days, but upon arrival, all of that is just talk, which will probably continue these conversations over the next several weeks as we learn more and more about this new variant. So how about the market's reaction to the new variant? This shouldn't be a surprise, but given the market's elevated levels, talk of interest rates, as well as the inflationary pressures we're all seeing, it's no wonder the markets are jittery. We haven't had a meaningful repricing for well over a year, and it's normal for the market to let off some steam to reevaluate the current levels before deciding on a new direction. This is where we are right now, and how long this evaluation period will last is anyone's guess. So let's move on and talk about the Fed. Right now, it isn't easy to see the next big thing that propels us in the market forward. The Fed has signaled it is considering speeding up the tapering to fight inflation. So November's job numbers was actually lower than expected, but the unemployment rate ticked down. So there's no excuse for the Fed to drag its feet because it's time to taper. If the Fed begins to taper faster, the next step seems to raise interest rates higher. It's the only effective way to combat inflation is to reduce the supply chain of money, to simply make money harder to access, and higher interest rates can do that. Higher borrowing and debt servicing costs will eat into corporate profits and lower stock market prices. Higher interest rates will provide an alternative also for investors who've had practically no other choice but to turn to the stock market for potentially decent returns. Now, again, as interest rates increase, that will affect existing bond prices. So we're keeping a really close eye on bond prices going forward. Now, one concerning news for this month is the labor market's results. While November's job numbers, which were 573,000 jobs estimated, was actually only 210,000 jobs. And this really may seem disappointing, but the unemployment rate actually ticked down from 4.2 to 4.6. And additional wages are rising, but they're not keeping up with inflation. So we want to keep a close eye on wage growth. Now, this jobs report was post-Delta and pre-Omicron, so maybe everyone who wants to work is working. Now, Delta was blamed for the low job creation that we saw in August and September. Then it snapped back in October. So job openings have remained stubbornly high, and there are more and more reports of people leaving the workforce and not coming back, which would explain why the unemployment rate dropped without a massive addition of new jobs. It is difficult to assess whether we'll see a slowdown in jobs because of this new variant, but we sense that a jobs slowdown won't happen because of how many jobs are out there. The next thing we need to look at is GDP, gross domestic product, which was stronger than Q3, but we have yet to see obviously what Q4 has for us. So we're going to wait to see the fourth quarter. But this is what the Fed is going to be taking a close look at, is the GDP numbers, because we need to see strong economic growth across the domestic markets as a whole. The other concern right now seems to be the very real potential of a government shutdown around the holidays or early next year. So the continued back and forth between the Build Back Better legislation and the debt ceiling will continue well into the new year. So there's very little for the market to pin its hopes, sadly, as we end 2021. That's going to be it for this month's SWAN Report. I want to thank you for listening every month this year, and we look forward to seeing you next year. If you have any questions about your personal financial plan, or if you want to take us up on our SWAN sleep study, this sleep study is with our goal of helping families sleep well at night. And how we do that is giving you a retirement report card on your retirement readiness. We talk about tax planning, estate and legacy planning. We talk about your income plan, and we give you an A, B, or C in each of these categories to make sure that you and your family are retirement ready. To take us up on this 1-hour complimentary visit, all you have to do is call 850-380-9558. That's 850-380-9558. We'll see you next year.